A lot of traders think that chasing a late entry is just a discipline problem. And it is partly that. If you miss the entry and jump in anyway because you don't want to miss out on the market move, then obviously that is a mistake. That's an emotional decision. But the bigger issue is that chasing a trade changes the maths of the trade. It's not just the fact that you've entered a little bit late and made a slightly emotional decision. It's the fact that the trade that you're taking may no longer have the same risk to reward profile that the original setup had. And if you're trading a system that's built around having a specific risk to reward ratio, then chasing entries and getting in at a worse price can quietly damage the entire expectancy of the system and may no longer be profitable. In this video, I want to show you exactly what happens when you miss a clean entry, chase the price, and turn a good trade idea into a much worse trade than it needs to be. So as I alluded to in the intro to this video, point number one is that missing an entry is not the problem, or not the entire problem. Okay, missing trades is a part of trading. You're not going to catch every single setup perfectly. Okay, I miss trades all of the time. Sometimes price taps your level and moves without you before you've had a chance to react. Sometimes you're simply not at the screen, or sometimes you may have an order sitting on the exchange and it just doesn't fill. All of this is perfectly normal. The problem is not that you've missed the trade. The problem is what you do after you miss it. The mistake is seeing price move away from the clean entry and thinking that it still looks like it's going to work, so I'll just get in now. And this is something that I see beginners repeat over and over and over again. The problem is, at that point, you may no longer be entering the same trade. So what I mean by this is that the original trade had a planned entry, it had a planned stop loss, a planned target, a planned position size, and a planned risk to reward ratio. So once you enter the trade late, all of that can change. The trade is no longer the same trade anymore. So point number two, I want to show you a real world example live on a chart. Before we do, let's have a talk through the maths. Okay, so if your planned entry is 100, your stop loss is 95, and the target is 110, your risk is 5, your reward is 10, and the result, if the target hits, is plus 2R. Okay, this is the trade that the system originally gave me. Okay, now I know where I'm entering, I know where I'm wrong, and I know where I'm taking profit. I know the reward is worth twice the risk. And this is designed intentionally, okay? The reward is 2 times the potential risk, which means that this trading system is being built around a 2-to-1 risk to reward ratio. Now, in our late entry example, the entry might be 104, so we're getting in at a slightly worse price. The same stop loss is still 95, the same target is still 110, but all of a sudden now the risk is 9, okay? And the reward is 6. So the result, if the target hits, is about 0.67R. Now, the chart might still look like it's going to go in the right direction. The target may still get hit, but this is no longer the same trade. This is something completely different. The original trade was a 2R opportunity. This trade with the late entry is now less than 1R. And this is a completely different trade mathematically. So let's have a look at TradingView, and I want to show you what I'm talking about here. We can see here a trade I took earlier this week. And we can see that this has a 5.18 risk to reward ratio, which means if I lose 1 risk unit, or 1R. If I win 5.18R. Okay, so this is my entry right here. But let's say I showed up a couple of candles later and I wanted to get in. If I got in a couple of candles later, which would have been a few hours later, just here. So this is only 3 hours later. On an hourly chart, that's not a great deal of time, okay? 3 hours later, all of a sudden we can see here the risk to reward ratio is now 1.35, right? So I'm risking 1 to win 1.35. Now I can tell you for a fact that the system that I trade with a 1-to-1 or a 1 to 1.35 risk to reward ratio is not going to be profitable over the long term. Absolutely not. You need to win such a high percentage of your trades in order to make a system like this profitable that it's almost impossible, and only the best traders can make that happen. As opposed to, if I had have got in at my original entry, I would have a 5.18 or 5.12. It's now slightly different based on the cursor, but the point remains the same, okay? So if you're entering late, it's not simply a matter of entering late, okay? The trade setup may still be great and it still may hit its target like this one did, but all of a sudden you're skewing the expectancy of the trading system. Which brings me to point 3, okay? R-based position sizing protects the loss, but not the upside. So let's talk through this, because this is an important nuance. If you're using proper R-based position sizing, you're not necessarily risking more dollars just because the stop loss is further away. Because if you've done your calculations based on the new entry, you're still only risking your fixed amount of risk. Now, you would reduce your position size so the loss is still fixed. So the issue is not always, am I going to lose more money? Because you can account for this with proper R-based position sizing. The issue now becomes, I'm risking the same 1R, but now I'm winning far less if the trade works, as I just showed you live on the charts. And this is the part that most people miss. Sure, the downside is still controlled, which is a good thing, right? It's important. But the upside has been damaged, the risk to reward has been skewed, and you still take the full risk, but now your winner, if you win the trade, is far smaller. Now, a trading system is not just based on whether a setup sometimes works, right? It's based on the relationship between a win rate, an average win, an average loss, and a risk to reward ratio. These are all key factors in calculating the expectancy of your trading system. So if your trading system is designed around 2R winners, so winning double what you risk, it does not need to win as often to break even. Obviously, same thing with 3R, same thing with 4R. The better risk to reward ratio that your trades have, the less you need to win. Okay, you can often find systems, and an example is a 2R system that breaks even roughly at a 33% win rate. So you can lose 2/3 of every trade and still break even. But if you keep chasing entries, and this is the point I want you to understand, if you keep chasing entries and turning 2R trades into 1R trades, you now need closer to a 50% win rate. You need to win half of your trades just to break even. Now, if you turn them into 0.67R trades, as we saw in the example, you now need roughly a 60% win rate just to break even. So you might think that you're trading the same system by getting these late entries or a slightly worse price. Maybe it's only a tiny bit worse. It's the same setup. It's the same direction. It's the same target, but the expectancy is completely skewed and your system is no longer profitable. And because you've entered late, the entire maths, the entire equation is shot. And now the win rate of the system may not be high enough to make that version of it profitable. This is why late entries matter so much. Now, point 5 is something we briefly touched on in the previous points, but chasing a trade turns a planned trade into a completely different trade. Okay, this is the key takeaway. The late entry is not automatically invalid, but it needs a rule around it. Okay, you can't just say it still looks good, I'm getting in. You can't chase price like that. You need to check some important points. Things like, is the original setup still valid? Okay, has price moved too far away from the original entry that this setup is no longer valid for me to get into? Has the trade already been invalidated, which is what we just discussed? Where the current price is compared to the entry stop loss on target, okay? Does the trade still meet my minimum risk to reward requirement? And this is probably the most important one, okay? Does it still meet my minimum risk to reward requirement? Because if it doesn't, you're going to need to win a hell of a lot more of these trades than you lose in order to just break even. Okay, and the last point is, am I entering because it still fits the plan or because I don't want to miss out? Obviously, FOMO is a big problem in emotional trading, but this video isn't about emotional trading. This video specifically is about late entries. So if the late entry ruins your risk to reward ratio, then it is not the same trade anymore. It is either a completely different trade or it's a no trade. And what you'll find in most cases is that it is a no trade. And this brings me to the final point that I want to make in today's video, and that is the practical rule around your late entries. So if you miss the clean entry, do not freestyle it, don't wing it, don't just ape in. You need to pause. Okay, pause before executing the trade, before doing anything, and recheck the trade. Ask yourself, is the trade still valid? Is the stop loss still correct? Is the target still correct? Does this fit my trading plan? And most importantly, is the risk to reward ratio still acceptable for my trading system? Now, I can't tell you what that is, the risk to reward ratio. There's no minimum. It depends on your trading system. I know people who make 1-to-1 work. They just win a shitload of trades. For me, that doesn't work. I don't win that many trades. I win anywhere between 40 and 60% of my trades. But the risk to reward ratio in my trading system takes care of it so that that is wildly profitable. Now, if you answer yes to all of the above points, then there may still be a rules-based way that you can enter your trade late. But if the answer is no to any of the questions above, then the trade is gone. And that is fine. There will always be another setup. Do not come from a place of scarcity. The worst thing you can do is turn every missed trade into a worse trade than the original one because you could not let it go. You could not move on. So the main point here is simple. Chasing a late entry does not automatically mean that you got in just a little bit worse. It can completely change the risk to reward profile of the entire trading system. And once you change the risk to reward, you may also change the expectancy of the system. So even if your position sizing protects your downside, it does not automatically fix the upside on these trades. You may still only lose 1R if the trade fails. But if the trade wins, you may no longer make the 2R or the 3R or whatever the original setup was designed to produce. And that is why you should not be just jumping into late entries because the chart still looks good. If you miss the entry, you need a late entry rule. Either the trade still fits the plan and you enter, or it's gone and you don't enter. And inside the 3XP Academy, this is one of the things that we help our clients install properly. Not just the entry setup, but the full process that sits around it. The levels, the risk, the position sizing, the late entry rules, and the decision-making process so that you are not freestyling when price starts moving. You've got a clear checklist and you know exactly what you're meant to do at all times. If you want to check out more details about how the 3XP Academy works, I'll leave a link down below in the description. There's a document you can go read and it has all the information there. But either way, I want you to walk away from this video with this. A missed trade is not the problem. Chasing a missed trade after the maths has completely changed is the problem. If you got any value from today, hit the like or subscribe button. Appreciate you watching, and I'll see you in the next one.